Hi, this is Carl.
This is Yao.
This is Michelle.
This is Nick.
This is Marcus, and we're going to be comparing Amgen and Johnson & Johnson's financials.
Amgen's net income in 2011 showed a 25.6% decrease to $3.64 billion from $4.63 billion in 2010. Although sales increased by 4.3% in 2011, operating expenses also increased by 18.5%, driven primarily by a legal settlement charge. This is the main contributing factor to the decrease in net income. Amgen's total assets were $48.87 billion in 2011 compared to $43.49 billion in 2010. The assets showed a 12.4% increase, which was primarily from an increase in cash and cash equivalents. Net cash provided by operating activities showed a relatively minimal drop of $600 million from 2010 to 2011. The major contributing change in cash and cash equivalents came from investing activities, meaning that they spent less and they sold more marketable securities in 2011. Their long-term assets showed no substantial change, but their liability and stockholders' equity were affected drastically by a 96.3% increase in long-term debt.
Liquidity ratios measure the ability of a company to pay its short-term debt. Any number greater than 1 means that their short-term debt obligations are covered. In 2010, Amgen's current ratio was 3.520 and 4.795 in 2011. This means that Amgen has positive short-term liquidity and can pay their debts more than 4 times. Asset management efficiency analyzes how efficiently a company is managing its assets to produce sales. The inventory turnover ratio signifies the number of times that inventory is sold and restocked each year. Amgen's turnover was 7.25 in 2010 and 6.16 in 2011, meaning that they could be at risk of stockouts, but because they're a drug manufacturing company, this should not be a problem. Total asset turnover ratio shows how efficiently a company's assets in total generate sales. Amgen's total asset turnover was 0.34 in 2010 and decreased to 0.31 in 2011. Meaning that they used their asset base to generate sales more efficiently in 2010 than they did in 2011. The financial leverage is most commonly found by finding the debt-to-equity ratio and indicates the extent to which a company relies on debt financing. In 2010, Amgen's debt-to-equity ratio was 0.45 and 1.12 in 2011. The debt-to-equity more than doubled in 2011, meaning that they had significantly higher amount of debt financing than in 2010. Financial coverage measures a company's ability to pay its fixed liabilities. Financial coverage for Amgen was 2.23 in 2010 and 1.64 in 2011, indicating that they can easily make payments and fulfill obligations to lenders. This also means that they are able to set funds aside in the event that income declines. Profitability ratios assess a company's ability to generate earnings compared to their expenses. The profit margin shows the percentage of each dollar that applies to net income. Amgen had net profit margin of 0.32 in 2010 and 0.24 in 2011, showing that they are making less per sales dollar in 2011 than they were in 2010. The return on equity measures the return on money that the investors have put into the company and is a key component that investors look at when deciding whether or not to invest in the company. Amgen had a return on equity of 0.19 in both 2010 and 2011. This is a relatively high number, indicating that Amgen is doing as well as keeping things consistent. The return on assets measures how efficiently the company is managing its investments in assets and then using them to generate profit. This shows how profitable a company is relative to their level of investment in total assets. Amgen had a return on asset ratio of 0.11 in 2010 and 0.08 in 2011. Meaning that they were less efficient in 2011 in using their assets to generate sales. Performance ratios depict the performance of a company and include the earnings per share and price-earnings ratio. The price-earnings ratio can examine a company's investment strategy in the current market and whether it has value or is showing growth. Amgen had a price-earnings ratio of 11.72 in 2010 and 13.39 in 2011. Indicating that the market will pay more to obtain Amgen's earnings in 2011, believing in their ability to increase earnings. Earnings per share shows the amount of profit allocated to each outstanding share of common stock, and it also is a measure of profitability. Amgen had an earnings per share of 4.82 in 2010 and 4.07 in 2011, showing consistency with their lowered net income.
We're going to start doing an external comparison with Johnson & Johnson now. Johnson & Johnson's net income decreased by 27.5% from $9.67 billion to $13.34 billion in 2010. Even with the sales increase of 5.6%, this couldn't cover the additional 17.96% increase in expenses incurred during the year. Research and development was the leading expense, contributing nearly 10.2% to overall expenses. This inequality resulted in a drop of net earnings. Johnson & Johnson's total assets at $113.64 billion in 2011 were an increase from $102.9 billion in 2010. The increase largely came from a 26.7% increase in cash and cash equivalents and a slight increase in their net intangible assets. Cash increased by $5.18 billion from 2010 to 2011, which helped combat increases in total liabilities. Johnson & Johnson's long-term debt increased by nearly $3.8 billion in addition with a very small change of $500 million in shareholders' equity. This overall resulted in a drop in earnings but an increase in gross profit. And this is a graph showing the external comparison with the income statement.
In 2010, Johnson & Johnson's current ratio was 2.05 and 2.38 in 2011. This means that Johnson & Johnson has a positive short-term liquidity and can pay their debts a little over 2 times. The inventory turnover ratio signifies the number of times that inventory is sold and restocked each year. Johnson & Johnson's turnover was 3.49 in 2010 and 3.24 in 2011, which is less than that of Amgen's. Although lower inventory turnovers may point to overstocking or deficiencies in product line, these numbers are appropriate for anticipating rapidly rising prices or expected market shortages. The total asset turnover ratio was 0.6 in 2007 and a decrease to 0.57 in 2011, which means that for every dollar the company's assets, they generated 60 cents in 2010 and 57 cents in 2011. In 2010, Johnson & Johnson's debt-to-equity ratio was 0.82 in 2010 and 0.99 in 2011. High ratios usually indicate that a company has been aggressive in financing its growth with debt. These numbers are pretty high, and because of the increase in 2011, this shows us that Johnson & Johnson had much higher rates of debt financing in 2011. Financial coverage for Johnson & Johnson was 2.22 in 2010 and 2.01 in 2011, indicating that they can easily make payments and fulfill obligations to their lenders. This also means that they are able to set funds aside in the event that income declines. The profit margin shows the percentage of each dollar that applies to net income. Johnson & Johnson had net profit margin of 0.217 and 0.149 in 2011, showing that they are making less per sales dollar in 2011 than they were in 2010. The return on equity is a key component that investors look at when deciding whether or not to invest in the company. Johnson & Johnson had a return on equity of 0.236 in 2010 and 0.169 in 2011. These are relatively high numbers indicating that Amgen is doing well as keeping things consistent, although they are less efficient in 2011. Johnson & Johnson had a return on assets ratio of 0.130 in 2010 and 0.09 in 2011, meaning that they were less efficient in 2011 and using their assets to generate sales. Johnson & Johnson had a PE ratio of 11.72 in 2010 and 13.39 in 2011, indicating that the market would be willing to pay more to obtain earnings in 2010 than they would in 2011. Johnson & Johnson had an EPS of 4.85 in 2010 and 3.54 in 2011, showing consistency with their lowered net income.
Amgen deals with billions of dollars in revenues and costs each year, so any significant percentage change in an account means a large sum of money. Amgen's performance has dropped off from the last couple of years. They boast about sales, which have risen, but net income took a drastic dive. They attribute most of this drop to a lawsuit payout, but there seems to be more to it than that. They had generated 32 cents out of every dollar into net income in 2010, but only 24 cents in 2011. It is costing much more to sell their pharmaceuticals. Their current ratio rose from 2010 to 2011, but only looks like a mass due to drastic increase in long-term debt. Amgen has close to $22 billion in long-term debt, of which only $80 million is current. The short run looks optimistic for Amgen, but the long run is much bleaker. Stock prices have risen due to their drive in sales, but the earnings per share has dropped. Amgen's stock has only 2.5 star rating out of 5. It is definitely questionable going into the future. With such a large debt, don't look to receive many dividends from Amgen going into the near future.
Because of the increase in price sales, price book value, and the common equity share price from 2010 to 2011, sources advise investors to decrease exposure. Pharmaceutical sales increased at the end of 2010, but then continue at a flat rate towards the end of 2011, which was the primary reason why book value share increased and shares declined. There was a substantial increase in cash and decrease in marketable securities during the last reporting period. Current assets increased. Accounts payable declined and contributed to a decline in current liabilities during the last quarter. A decline in short-term liabilities was offset by an increase in long-term liability as long-term debt increased and short-term debt decreased. Current assets are more than twice as large as current liabilities. During the first quarter of 2011, cash flow from investing was greater than the cash flow from operating activities, as they generated cash from the sales of investments. Investing and operating activities are what supports the company's long-term cash balance growth. Johnson & Johnson is carrying a significant amount of debt, roughly $13 billion in long-term debt, $1.5 billion due in 2013. In conclusion, Johnson & Johnson would be a more stable company to invest in than Amgen.
Thank you.